Thanks for joining us for our podcast focused on U.S. and Indiana farmland values, the 2024 update. I'm Jim Mintert, director of the Purdue Center for Commercial Agriculture, and joining me today are my colleagues, Dr. Todd Kuethe, who's a professor here in Ag Economics, and Michael Langemeier, who's also a professor of Ag Economics and associate director of the Center for Commercial Agriculture. Todd, let's talk a little bit about what's taking place here with respect to farmland values. And I guess our starting point is really the farm sector balance sheet, which was published actually just this past Friday by USDA's Economic Research Service. And I know you and Michael both take a close look at that when that report comes out. So I'll kick it off by maybe letting you and Michael comment on that.
Sure. For me, the big thing is it gives us sort of a idea of what is happening at the national level in terms of the farm sector, how they're managing both debt and assets, right? And so the big takeaway for me is always looking at what they're projecting or forecasting aggregate land prices to look like. And then also how that sort of fits in with the rest of the balance sheet. And again, farmland is the major share of assets for the farm sector. They're showing 83% of all of the assets, right? So that's why when we think about things like long run financial planning, farmers' retirement, everything sort of always comes back to sort of what's happening with the land values. But I know Michael maybe thinks about things a little bit differently as a fund management.
Very consistent with that. I mean, I think you'd characterize the aggregate farm sector balance sheet as being very strong, and particularly in the non-current side of the balance sheet. And that's primarily because we've seen some pretty healthy increases in farmland. We're going to look at U.S. farmland trends here in a little bit, but they've pretty much just been going up for quite some time now. And so that's made this non-current portion of the farm sector balance sheet really strong. I do want to comment a little bit on the debt to asset ratio. It's coming in at 12.8%. It's very important to keep in mind that includes part-time farms, semi-retired farms, full-time farms. If you look at the debt to asset ratio for full-time farms, it's much closer to 30%. And so if you look at farms that are doing this for a living, they tend to take on a little bit more debt, but nevertheless, 30% is still a really healthy debt to asset ratio, and with strong farmland values, that balance sheet, it remains strong.
Well, I always try to remind like my students or extension audiences that this debt to asset ratio is really just sort of what is the aggregate debt in the farm sector and what is the average or the aggregate assets, and then looking at the relationship between those two. Not that it really captures any person or group subset of the farm sector or the subsector. It's really sort of like national accounts, the way we think about things like unemployment or inflation, of like, what is sort of the macro perspective on how the farm sector looks? And it sort of for the last 20 years has sort of hung around that, sort of fluctuating around that 12 to 14% debt to asset ratio, right? So it's part of the reason that our sector is viewed as like at least very stable in kind of a long run financial viewpoint, even if we have sort of periods that are challenging. If you look at sort of the long, sort of slow moving arc of the sector, it's usually pretty healthy.
Yes.
I think Michael's point is the fact that if you look at the debt to asset ratio, for example, for Corn Belt farms that are engaged in growing corn and soybeans, which is the group that we talk to a lot, that picture looks a little different, right? And I think your point, Michael, is at least entering into this downturn of commodity prices that we're seeing, we're still walking into this with a pretty strong debt to asset ratio.
Yeah, but I would just try to emphasize what we're trying to do here is tell people, even though we're looking at weaker incomes, and we can talk about incomes in more detail, but even though we're looking at weaker net returns, weaker incomes, particularly lower net returns for corn and soybean producers, because farmland is valued still fairly high, we've got a strong balance sheet.
Yeah, good point. So when you start to worry is if we see some weakness show up in farmland values.
Yes.
Yeah.
All right.
And so there's a reason why we focus so much on farmland values.
So Todd, you spent a number of years working at USDA's Economic Research Service. And so you're kind of the inside man with respect to knowing how USDA collects data with respect to farmland values, and also how we collect data here in the state of Indiana with the Indiana Farmland Survey, and they're different. So let's talk a little bit about the values that USDA collects, and we're going to start off by looking at the long run U.S. farm real estate value, but we'll also look at some broader cropland values as well. Talk to us a little bit about how USDA collects data, because those numbers are different than what you show and what Iowa State shows, and what University of Illinois shows, et cetera, right?
Yeah, so a lot of what the land grants do is we tend to work with, as we do here with our survey, work with appraisers or lenders, folks that are involved in farmland transactions. The USDA surveys, principally, USDA generally surveys farmers a lot, right? So this actually comes from what they call the June Agricultural Survey, or used to be called the June Area Survey, which is mostly about production and what crops farmers are growing in the summer, right? It's taken in June. And then there's a couple questions in there about land values and cash rent. And so NASS assembles those from those individual surveys, and they survey thousands and thousands of farmers around the country, and what we call sort of a stratified survey. And so they're surveying intensively in places that a lot of agricultural production is taking place, and surveying to get an accurate picture of sort of what crops are in the ground. That's the main point of that survey. And then they sort of aggregate up so they ask initially, like, what is the land that you're farming? What do you think it's worth? Or what's the expected market value of the land as of sort of June of that year? And then it gets aggregated up at the state NASS offices and up at the national offices. And at the beginning of August, they release this annual land values cash rent report, which is historically sort of called like the gold standard of farmland values. But one of the issues is it's sort of what I would say is a better measure of sort of the stock of farmland, or if you think the stock of the asset of land we have in the country, where our surveys and the ones that similar surveys around the country run by land grants is really acting people that are involved in the marketing, right? Which is more of like the flow of farmland. So looking at that sort of 2% that changes hands is really informative to what we think of in the value, where what USDA reports is what is the aggregate stock of land. And so that's why you tend to see it move much slower. It's not quite as dynamic. But again, it still picks up, since 2020, we've had this sort of continued high growth in land prices at the national level. This is the lower 48 contiguous states, where we see sort of a flat after that high growth period out of post RFS commodity price boom. Then it kind of flattened off for a while. Then around 2020, we see it take off again. And so that's sort of the long run. And that's kind of the difference why we pick up a little bit difference in sort of what we see in per acre estimates.
So even here, though, when you look at the aggregate value for farm real estate values over the last roughly 4 to 5 years, that's a pretty sharp move upwards, even in those values. The dollar value looks low because it's $4,170 dollars per acre, which sounds low. But if you look at this change that's taken place since about 2020, it's pretty dynamic.
Yeah. Particularly for these sort of large aggregate surveys, it's hard to get them to move quite a bit, right? They're looking at everything we define as. The other thing I should point out is that this is their value for farm real estate, right? Which includes buildings, structures, improvements, right? This is sort of the biggest aggregate number we can think about in terms of what we would classify as farmland or agricultural land. And so, to see that kind of persistent growth rate means that like prices were really growing.
Yeah. So we saw a big upward move these last 4 to 5 years. And that's even maybe a little more apparent when you start looking at it at the individual state level and you did a comparison of Illinois, Indiana, Iowa versus the U.S. number.
Yeah. And so this is, again, that farm real estate. They release it for the states. They also report crop and pasture, crop split into irrigated, non-irrigated. Generally, I think the USDA numbers, the bigger area, a bigger bucket of things you're looking at, the more I feel like you do a really good job tracking it. Sort of like we were talking about with balance sheets, if you want to think about individual farms, there may be better sources of information for that, right? So, and really, I always look at this to see for a couple of reasons. One, I think people here in Indiana always think about the sort of that I-state region. And you can really see we have the same dynamics that we see sort of the national level. But again, when we include the national level, those changes look almost flat compared to what we see here in the Corn Belt. So we tend to appreciate a lot higher when we do. And then when there are periods where it dips, it tends to dip a lot more. So it's much more dynamic. And those, again, I think a lot of farmland owners, when they look at the USDA values, still think that they feel like they're always very low. Again, of sort of how they track that data, but you can really see that appreciation, what we saw, sort of coming out of 2020, that rapid uptick.
So, when I look at the USDA numbers versus the numbers that you publish for Indiana or Iowa State publishes for Iowa, for example. I think the difference from my perspective is more along the lines of the land grant university surveys are picking up what's taking place on the margin.
Yep.
Those are based on transactions that have occurred recently. It's not transaction data, but it is based on recent transactions. Whereas when the USDA surveys people, it's asking people, what do you think that property's worth, which is influenced by recent transactions, but really has kind of a little more of a longer term perspective to it.
Yeah, and it's almost more of like a balance sheet measure, right? What is what we have? What is that worth? Which is different than what's selling right now, right?
So looking at the numbers, USDA was up this year, right? And if you look at what the lead number there is Iowa at 94.20 per acre, Illinois is at 8,700, Indiana comes in at 85.10. Michael, I know you've taken a look at this with respect to what accounts for those differences across states. What do you see?
I think it's very consistent. If you think about corn yields, the higher corn yields tend to be in Iowa and in central Illinois, but by the time you factor in southern Illinois into there, that brings their number down a little bit. And so I think it's very consistent. If you look at corn yields going from Iowa all the way to Indiana, a couple observations here that I think are very important when you're looking at long run trends. I talk a lot about what has happened since 2007 when we were starting the ethanol boom. That's usually the time period I pick to talk about these trends. And both the U.S. data and the three I states have more than doubled. Land values have more than doubled since 2007. And I want to bring that up because that's so important to the balance sheet. As long as the farmland values still stay relatively high, we're going to have a strong balance sheet because farmland is over 80% of the U.S. balance sheet. Another observation, when you look at the I states, it seems to me that Illinois and Indiana are more correlated. They seem to track each other a little closer than Iowa, though Iowa is also correlated with these other two states, but not as much. And in particular, I don't think I'm making something up here, Todd. It seems to me Iowa, it has higher highs and lower, and when there's an adjustment downward, they tend to adjust more than Illinois and Indiana. And I don't know if that's part of the urban influence coming from Illinois and Indiana or what's going on there, but it's very evident when you look at the Iowa State Survey and also the U.S. data for Iowa, Illinois, and Indiana.
That's an interesting point.
Yeah, there's a lot of sort of discussion of why maybe Iowa is different, right? They also have some different ownership laws about who's allowed to own farmland, limits on how land can be subdivided by a single owner. There's a lot of people and we have some colleagues here in the department working with folks at Iowa State, try to maybe look at some of those issues about maybe how different policies might be interacting there. But yeah, I mean, there's also the sort of the agronomic part of it. Most of Iowa's, very productive. And so they don't have sort of large forested portions or, maybe I guess you can go back to glaciers or something to think about how that soil gets allocated. But I really think it, like you said, it really comes down to sort of how much output can you get per acre, and then people basically buy access to that output for the life they're going to hold it.
Yeah. So you look at those differences across state. Most of the differences can be explained by yield, which means you're looking at, if you look at value at a per bushel basis, they actually come out fairly close with a little more extreme volatility on the Iowa values. All right, so let's turn our attention. Those are the USDA numbers. Let's turn our attention to the Purdue survey, which has been going on since the mid 1970s. And you've taken charge of that here these last 4 or 5 years. So explain to us a little bit about what you do with respect to the Purdue survey.
Yes, I mean, I always kind of start with kind of why do we do a survey? And, it was started in the late 1970s for a reason, which is when we had sort of exploding land prices and people were really concerned, wanted to get a better idea of what's going on here. And at that time, there were limits to how you could access transactions. So the best thing to do was to survey people involved in those transactions. And so we've continued that tradition since the late 1970s. Where we ask people we define it as people who interact with land markets as part of their regular job. So that's usually a lot of appraisers. We have some lenders in there. There's a few sort of, farm landowners in there as well. And just sort of get an idea, what does the land market look like when we do the survey? So it's always done in June. But then obviously We're always interested in kind of the winter time where land sells a lot more. Also, that's when people kind of think about their balance sheet generally. So we ask about the June land values at June, but also the previous December, and then make some projections what they think the year will end up at the end of December. The things that sort of differentiate our survey, in addition to who we ask, but also we split it out by quality grade. So the USDA is just sort of your farm, right? We're here, we are asking people to sell land. What do you think about the top land, the average, the poor land in your market? We don't really define those for them. Part of the thing is our participants usually have done it for a very long time. So they think about this naturally, but we ask them so we ask them about the counties that they operate in, and then, or they serve in their business, and then top, average, and poor. And we ask about corn yields. What's the expected long run corn yield or productivity of top in your area or average area? So recognizing that top quality land in some parts of the state is very different than top quality land in other parts, but it allows us to sort of put that in that productivity difference. And then we also ask about cash rental rates. But that's sort of the basic structure of our survey.
So tell us again who you talk to. You talk to people engaged in the land markets.
People that interact with the land market regularly as part of their professional life. So mostly appraisers, farm managers, lenders. And then we have a few other folks in there as well.
There are some producers in there, but not a lot, right?
Correct.
That's not a large portion of your survey. So.
Correct.
So again, it gets at this idea that you're capturing values that are more on the margin because it's based on recent history of transactions, even though it's not individual transaction data.
Yeah, we sort of ask them what is sort of the typical value for each quality grade in the market that they work in the county that they're in.
All right, let's get to the numbers because that's what probably listeners have been waiting for.
Yes.
So what'd you find out for this year versus last year?
Well, so prices are up about sort of 4%, somewhere between 3.5% to 5%, kind of in aggregate, across the state for top, average, and poor. And that's sort of the most likely outcome over the history we've done the survey, right? That sort of 4 to 5% increases. Very different than what we've experienced the last several years, where we had record high appreciation in 2020, really strong appreciation 21, 22. And so now we're sort of back to kind of like what I would say is sort of the expected kind of market activity. So prices are up a bit. The other thing is people always kind of look at these threshold values, right? So we're above 14 at the top. We're approaching 12, still in the 11 bucket at the average, and above 9 at the poor, right? So people seem to always kind of look whenever we cross one of these sort of 1,000 or 250 or 500 threshold, that's sort of people kind of anchor to that, right?
Yeah, so rounding off slightly, you came up with 14,400 at the top levels for Indiana for this year. Average was at 11,600, and then just barely above $9,000 for the poor quality land. So your percentage ranges, your lowest one, it was actually for the average quality at 3.7. Your highest increase was actually shown for the top quality, 4.8%. Michael, as you look at those numbers, how does that correlate with what you were expecting to see?
About what we were expecting. I think Todd, both of us were talking 0 to 5% increase, and we fell in there. And let me talk a little bit about why land values tend to go up. There's a couple things going on there. First of all, we asked them for long-term yields. They go up every year, 2 or 3 bushel. You can just pretty much like clockwork, 2 or 3 bushel increase in those poor, average, and top corn yields. And so the productivity, we're getting more from that soil. And so that would tend to have some upward pressure, but more importantly is inflation. And so you can easily explain that long run average. I think you go back to 1960, Todd. I think the average increase in farmland value is about 5.5%. So each time you get inflation there, increase in productivity, you can explain why land values tend to go up. That doesn't mean they always go up, but there's a reason long-term why they tend to go up.
And, Michael, thinking about your comment earlier about land values doubling since 2007, that actually fits right in with that long run average, right?
Yes.
Even though there were some years and there were some big jumps, there was also some weaker years as well. And so over that longer period of time, you're right back to that, pretty close to that average, right?
Yes.
All right. So people are always interested in the regional values. Tell us a little bit about the regional calculations and how those are arrived at.
Yeah. So we have this set of respondents that again report for their county. And then we aggregate that up to the state level, obviously, but then it's also split into these 6 regions in the state. To be totally honest, I'm not, this predates me by a long time, how these regions were, put together. And it seems like everybody I talk to would like the regions to be defined a little differently than they are. But these are the regions that we kept just to have a long history of the data. And then obviously we, have areas that have sort of more active land markets than others, and sort of more of those professionals that work in those spaces. So, as you move farther down in the South, we maybe have fewer professional farm managers, fewer appraisers, lenders. So we don't have quite as much coverage there. And those markets are a little bit weird. So for a lot of reasons, we tend to see much more dynamic sort of movement year to year in the southern part of the state. In terms of prices up and down.
We should probably characterize what you mean by the word weird.
Oh,
Unusual, maybe.
yeah. Sorry. Let me say
What are you
that
thinking
again.
about there?
Yeah. Where did I say weird? I'm not even listening to myself.
You characterize Southeast and Southwest as being, and I think what you're really focusing on the fact that you've got more things influencing land values.
Southwest,
than just corn and soybeans.
Southwest and Southeast, we can't just think of it as bare corn and soybean land, right? We have forest, we have recreational lands, we have a different mix of commodities, complex set of commodities. There's a lot of things that can drive that land price other than just corn and soybean yields, right? And so the prices tend to be driven by different set of dynamics than we do in just a corn, soybean, flat corn and soybean area. And then in addition to that, we sort of have fewer land market experts that really operate in those areas. So they're much harder to characterize for a number of reasons.
And that contributes to the fact over the years, you get more variability showing up in the values for Southeast Indiana and Southwest Indiana.
Yep.
For all the reasons you just described, right?
Yeah.
Now, one thing I want to make sure, and we probably should have said it earlier, Todd, this is not, we're talking about non-irrigated land.
Correct.
Yes.
We ask about sort of bare farmland, corn and soybean production land, right? So we're also not really thinking about pasture.
Yeah.
Or
hay ground.
Yes, or hay. Yeah.
So as you look at it, given all those caveats, the top end was what and where?
So the top value per acre are typically found in the upper part of the state. That will shift around year to year, but generally hangs around the central, west central part of the state. Occasionally we'll see the north or northeast kind of dominate that. And we see those parts of the state, the increases are much closer to what we see in aggregate, up by a little bit. Then we get to sort of different quality grades. The lower quality land tends to sell for reasons not just the agricultural production, right? So we do see sometimes those markets tend to be sort of, again, more fluctuation in terms of going up faster or going down slower, or going down faster when they're declining.
So the typical is to see the highest values on the highest quality land in the northern half of the state. But in this year's survey, you showed a big jump for Southwest. And actually it came in at the top end for the whole state, which I have to say was surprising to me. I didn't expect to see that. But again, I'm thinking about the data collection process in Southwest, and actually thinking, we were talking about this before the podcast started, the fact that the Southwest region really could easily be subdivided into 2 regions, right? One with fairly intensive corn, soybean production, and another component without a lot of intensive corn, soybean production, a lot more pasture land, a lot more timberland, et cetera, right?
Yeah. And the other thing too is that, and we'll talk about urban influence and development. And we give our respondents the opportunity to give us just sort of some general market commentary. And in the South, we've gotten in the last several years, a lot of the things about, people buying farmland for retirement purposes, or potentially maybe to convert it, or they'll buy it to have a small house and rent. And we see a lot more of that activity in the southern part of the state too.
Yeah, which contributes to the variability, right?
Yeah.
All right. So if you take a look at the Indiana values and look at it over time, that chart is kind of interesting just to take a look at, and the steepness of the increase that's taken place, especially for top quality and to some extent average quality land over the last roughly 4 to 5 years, is quite striking.
Yeah. In fact, when I took over the survey in 2020, right? And so we had that kind of, obviously the start of COVID, there's a lot of uncertainty as to what was going to happen. And we saw these really high farmland prices really across the Corn Belt in general. Same thing with Iowa State and the USDA, with the things that they're running. And then there were a lot of people that said, well, this doesn't seem to be sustainable. We don't think this will happen forever. Right. And we're seeing we're not seeing a decline, but we're seeing sort of a slow increase over the last year. And some evidence that maybe that growth is starting to slow a bit. But yeah, this is not the giant inertia we had coming out of 2020.
So one of the things that you do on the survey, and this goes back a number of years, is to ask people about a series of factors that could potentially influence land values, and share those results with us.
Yeah. So this is without a doubt my favorite part of the survey, in part because this is the thing people hassle me about the least, right? The prices people will say like, oh, I don't think this is quite right. But this one, it seems like everybody kind of agrees, right? And so we ask all of these experts, what these things that we tend to think sort of move farmland prices, which is basically the returns you get from owning farmland. That's the biggest one, right? But then all of the things we think about as farmland as an investment. So how does it compare to other investments? What are the interest expenses we'd have on a mortgage, right? And then ask them to rate, is this important in your market now? And as it ranges from, very important and positive to very important and negative. We ask them sort of on a 5-point scale, how much is this really happening? And then we aggregate those up. And so we think about like 2020, for example, when I took over the survey, everything that we would ask about from income to crop or to commodity prices, interest rates, exports, inflation, agricultural policy, they were all putting positive pressure on farmland prices. So everything that we think could drive farmland prices is really pushing prices up. And then over the last couple of years, we've started to see interest rates putting negative pressure as the Fed was increasing interest rates. And then we see our mortgage rates increasing. That's putting downward pressure, moderating pressure, what we sort of had the last couple of years. Into 24 now, we're seeing downward pressure from commodity prices, particularly crop prices, but also farm incomes, export levels. And now starting to actually see a little bit of downward pressure from the return to alternative investments, right? So as the economy starts to improve and change, they're saying, well, actually, there's maybe other things we could be getting better returns from than farmland. So maybe there's a slowing sort of non-farm investment interest in farmers or people outside of the farm sector. What are they looking at other things to put their money into?
So Todd, given that Michael and I do the Ag Economy Barometer, I've kind of turned into an index person. So I'm looking at the results, and I think I could start thinking about a way to build an index out of this.
Oh, okay.
And if you look at it, this year, it's really interesting. 7 of the 10 factors are showing negatives. And as you pointed out, 3 or so years ago, 10 out of 10 were positive. This strikes me as really starting to illustrate a shift in where we're headed with respect to farmland values.
And I'm going to stick my neck out here. And let's look ahead to 25. And of the factors in 24 that are positive, livestock price is probably still going to be slightly positive. The growth in returns, I'm not exactly sure how they're interpreting that, but that probably will say slightly positive. The one that I'm worried about is liquidity. We're burning through some liquidity now because of lower net returns. People are going to want to hold on to that liquidity and not necessarily dump it into the farmland market like they did the last 2 or 3 years. And so 2025, I'm not saying we're going to have a crash. I just don't think it's going to be similar to 24, if not slightly worse, if you look at the factors.
Well, another thing that I didn't put in here, I talk about it in the report, which also to go back, those regional things are all available in the report, right? So we mostly focus at the state level. Was asking about land converting out of agriculture to other things. And that's the thing that's what everybody's talking about in Indiana the last 2 years, right? And it goes to things like solar development, but also, large public projects, large private projects, housing construction. So I did ask about that. I didn't put it in because we only have the year for 2024. But that is almost as strong as interest rates, but in the positive. So what they're saying is really that conversion potential is really holding prices
on
up.
the positive side.
Yeah. And then the other thing here that we don't sort of include in this bracket that we ask about is the volume of land for sale in the market. And everyone is reporting there's a lot less for sale in 2024 than what we saw in 23. We saw the same thing in 23 relative to 22. So the supply, sort of people not as prone to want to sell their land to someone else, is really kind of keeping that price high, right? Because the demand is still pretty robust. We see a lot less for sale, so that's kind of keeping prices up. But those are the kind of things off of this chart that I think could still kind of help keep land prices up
In that 0 to
going
5%.
Yeah,
range.
that will keep it from totally maybe tipping downward.
Following up, though, I guess putting a little wrap on this with respect to what Michael was saying. In this year's survey, liquidity was still a positive.
Yeah.
Looking ahead to the next year's survey, I think, Michael, you're kind of anticipating that turning
More
into
neutral.
a negative.
More neutral, slightly negative.
Because people are going to want to hang on to
Yeah.
it, right? If the downturn continues, which is kind of what we expect at this point. So one of the things that influences farmland values is what's going on with interest rates. And we just saw that with respect to the survey question about factors influencing values. So you took a look at farm mortgage rates versus the federal funds rate, which is the policy rate, and the prime interest rate. Talk to us a little bit about that.
Yeah, so I mean, we ask in the survey about expected interest rates, right? When one of the challenges is kind of which interest rate do we think about, right? And as economists, what interest rate do we think about when we think about the farm sector? So obviously, we see a lot of discussion about the Fed funds rate. That's the policy rate. That's what the Fed pays banks on overnight deposits, right? And that's the one that they can influence, right? So the Federal Open Market Committee gets together and they vote, what should the interest rate be? Banks take that information and they use that to inform how they set other rates. The one that we think about next, I think, is the prime rate, right? So that's the short run business lending, which has a relatively fixed relationship to the Fed funds rate, basically their cost of doing business, right? So we want to charge these successful businesses as least we can to keep them as part of our financial relationship. And so they tend to sort of move lockstep. Where farm mortgage rates, they use that as part of the information set, but they also look at what's the risk of lending to the ag sector in long term relative to businesses, right? There's a lot of things that sort of go into that. And so, over the last couple of years, we've seen the Fed increase that policy rate, started to level off a little bit. They're giving some indication that it could decline. And we saw prime rates sort of move lockstep with that in terms of what they've increased and sort of held steady. The farm mortgage rates have gone up, but not as fast as what we've seen for the Fed funds rate or the prime rate. In fact, now we see the farm mortgage rate below the prime rate, meaning that lenders essentially feel more confident that long-run investments in the ag sector are better than short-run business commercial lending. There's a lot less risk there, they feel, right? And so, if the Fed starts to unwind and decrease the Fed funds rate, we could maybe expect prime or farm mortgage rates to start to come down, but I don't think we'll see them quite as quick, in part because it hasn't built up as quick. And there's less of a cushion between that and the farm mortgage or the Fed funds rate.
So stated another way, right now, the prime rate is running almost a full point ahead of farm mortgage rates based on the most recent data that we've had.
Yep.
And if the Fed loosens, as almost everybody expects over the next few quarters, the likelihood is we'll see that prime rate and the farm mortgage rate probably collapse on each other. Does that seem?
Yeah, I think that's more likely. Right? I think the most likely is you see the farm mortgage rate move very little and the prime rate start to come down to it.
Michael, I think you had a comment with respect to thinking about what this means with respect to the capitalization rate and the impact of farmland.
I don't want to confuse the listener here, but we throw these terms out. The interest rate obviously is very important to land values, but we also have this term called capitalization rate, and what that is cash rent divided by land values. And the point I want to make there is that's trended downward for a long time now. And currently it's about 2.5%, if not slightly lower, depending on the region you look at, the state you look at. I think for Nebraska, it's closer to 2%, for some land I own out there. And so it's really low right now. If these interest rates stay relatively high compared to what they have been since 2008, there's probably a little bit of pressure to increase the capitalization rate a little bit. There's certainly not a 1-to-1 there, but higher interest rates over a long period of time tend to increase the capitalization rate, not just for land, but also for stocks. But given the fact that as we were talking about earlier before the podcast, given the fact that the Fed's going to adjust the Fed funds rate and the prime rate's going to come down probably 2%, there's probably not that much pressure. So what I'm really arguing in a very roundabout way is the current 2.5% capitalization rate is probably going to hold for a while. We're not going to go any lower, but given this that the Fed's reducing the interest rates, it's probably taken off a little of the pressure to increase those.
Yeah. Stated another way, if the Fed wasn't going to loosen, there might be some pressure to raise that cap rate, and raising the cap rate has a negative impact.
Decreases land values.
On land values. Lowering the cap rate has a positive impact. And it can actually have, particularly over long periods of time, big impact.
Oh, huge impact
on values.
Part of the increase from 2007 to today for land values is low cap rate.
Yeah.
Low interest rate and low cap rate.
And you can make that argument with respect to every asset in the U.S., right?
Yeah, stocks.
Yeah, that's
Commercial
sort of
real estate, residential real estate.
Macroeconomists talk about sort of the secular decline of cap rates, cap rate suppression across the economy since the 90s, really.
Right. So one of the questions, and you kind of alluded to this earlier, is this whole idea of the development premium. And so you've been asking about that more explicitly in the survey, right?
Yeah, and we've tracked, since the start of the survey, the value of land transitioning out of agriculture, right? So, and that's a big market driver, particularly in submarkets where we see a fair amount of development. But then there's kind of spillover effects to where it'll affect places all over the state. And so I think the thing that I get calls and requests about the most over the last couple of years is really questions about what do you think development is going to do to land? Part of it is we're seeing, we've always had sort of, across the Corn Belt, across the United States, kind of like urban fringe development and conversion of land. But now we have things like solar or other infrastructure projects that are maybe happening outside of that sort of, traditional kind of suburban ring. And so there's a lot of concern. So we look at the value of land transitioning out of agriculture, and that's always been high above what we see even for top quality land that sort of remains in farming, right? And we're actually looking closer now to more than doubling your land, again, on average across the state. If you sell it for transitional purposes, you'll more than double what you would make for agricultural production.
Yeah, to put that number in perspective, you're showing just 14,400 for top quality land in Indiana. And with that development or transition premium in there, you're up over $30,000 an acre. Right?
Yeah. And so again, we have more than doubling in terms of, going from 1,440 to, 30 to 31,000 an acre.
Obviously, as you get closer and closer to where it's already been developed, that 30,000 will be higher. This is an average.
Yeah.
Just want to point that out.
Yeah, no, and people, I'm sure you get it as well, call with some very high sales and places say, can you believe what this one happened?
Oh, yeah. Very close to where there's already development.
Yeah.
So the interesting thing, Michael, is, we've been asking about the impact of various factors on farmland values in the Ag Economy Barometer survey. And it's a different survey, different pool of people. And it's a national survey as well as, and not just an Indiana survey. But one of the things we've been picking up lately is people telling us they do see an impact coming out from energy development and really focusing on the combination of wind and solar. And that most of those are for rental agreements, not for sales. Very few that I'm aware of anyway in Indiana would be a sale for solar development. Almost always those are leases. But that's a factor, right, going in here as opposed to a factor influencing land values, right?
Certainly.
Yeah. Rental rate goes up, the present value of the land goes up.
So you looked at a little more specific aspect of development, namely what's going on in the housing market relative to land values.
Yeah, and part of it is that's the easiest thing to track, right? So the state of Indiana has You can look at housing permits by county, by the state level. And really looking at housing construction permits, saving data, really tracks how that transitional premium, so that transitional land relative to top quality farmland, really follows what we see in terms of permit construction, right? So we had really high amounts of construction from kind of going the 1990s till probably right before around the 2008 financial crisis. And then when we see that happen, we see a real reduction in permits and construction, and that housing premium that we see, or that transitional premium from it, really fell. And then starting about 2010, 11, 12, we start to see that rebound and start to rebuild in construction. And then we see that premium really go up again. And so, in fact, that premium is like almost back to where we were pre 2007, 8, but just still a little bit below what we were seeing in terms of a percentage value. And similar with construction permits, right? So construction has really gone up, but we're still below where we were kind of right before the financial crisis.
So looking at the chart that you've got, and just to remind the listeners, you have an opportunity to download the charts that we're looking at as we record this podcast. But looking at the chart, it's really interesting to see that development premium in about 2011, 2012 got pretty close to zero above just top quality. That's to me, I have to say, a little bit surprising.
Well, maybe it is a little bit surprising, other than, I've done some research in other parts of the Corn Belt. And that was sort of observed around that time. And again, it goes back to that RFS, right? Where commodity prices are so high. The cost of borrowing is so low, right? Because the 2008 crisis, also when we cut rates to the historic low, the first time they've been that low in probably ever. And so the value of land for its agricultural purposes was particularly high. There was very low demand for transition, and farmers it was a golden age of commodity prices. And so it really drove that premium down. In fact, there were, I remember at that time talking to people that bought land to convert it, realizing with the financial crisis they couldn't convert it, and they were like, "We don't want to sell this back. Now we want to keep it as farmland. Tell us how to farm it," right? Because the commodity returns were so high at that time.
And your data is looking at Indiana housing starts or permits, but actually on a national basis, those also collapsed during that time frame.
Oh, so you had even more so than we had in Indiana.
Yeah, you had two things going on at the same time that were causing the relationship to do exactly what your data is showing, right?
Yeah, which essentially we have one sector of the economy, a huge sector in terms of housing, construction, that was just, record low, while we as a sort of commodity production, particularly corn and soybeans, record all-time high, right? So we have sort of the doom and gloom in one area, golden age in another, and you can really see that in the data.
So Todd, one of the things you do in the survey is ask people not only what change in price or value they saw in their region from December to June of this year, but you ask them to project and forecast what they think is likely to happen between June and December. And those results are very interesting.
Yeah. So the first part that is interesting to me is what our respondents observed between December of 23 and June of this year when the survey went out, June of 24, which is in aggregate kind of across the state, they saw prices declining, right? So meaning that aggregate increase we saw from June of 23 to June of 24, mostly that growth took place at the end of 23 and has been declining at the first half of 24. So some indication maybe that, at least in kind of a local time, again, we've seen maybe kind of a peak and prices starting to recede a little bit. And they actually expect that decline to continue through the rest of this calendar year. So they saw prices declining in the first half of 23 or 24, relative to 23, and they think that's going to continue. But again, at the top and average quality, a little bit more muted. Actually expecting, maybe the decline to increase a little bit in that poor quality land across the state. But again, they they aren't really optimistic about sort of the rest of 24.
And when I look at your data, particularly this projection for the last half of 24, it makes a lot of sense to me. What they're really saying is they expect demand to hold pretty strong on high quality farmland and the pressure to be mostly on poor quality land, fewer buyers stepping up to the plate. Makes a lot of sense from a farm management standpoint. Do you agree with that, Michael?
Definitely. We're not talking about cash rents here, but the profitability prospects on poor quality land are not near as good. None of them are good, but not near as good as the average in the top.
So, Michael, this is a good time maybe to talk about what we picked up on our most recent Ag Economy Barometer survey, which was done in the middle of August. And of course, every month we ask people about their farmland price expectations looking out 12 months. And I want to emphasize this is a national survey. It's not an Indiana survey, so it's a fairly broad survey. But the results in August were quite interesting and really kind of correlate with what Todd was picking up on the Indiana survey.
Definitely. They're still overall optimistic, but only by a slight amount. If you did an index of this, it'd be 105, where 100 is neutral and below 100 would be pessimistic. And essentially what happened in August is we saw a 10 to 11% increase in those that said lower farmland values. To put that in perspective, it was about 13% in July. Now it's 24% in August. That is a huge movement. It's pretty rare since we've been asking this question that we've seen that big a movement in terms of people that think we're going to have lower farmland values in the next 12 months. The people that thought we were going to have higher farmland values also went down a little bit, but it's very, very noticeable that the pessimists came out of the woodwork in August compared to July.
And when you look at our survey for the barometer on these farmland values going back to 2021, and that's when people were most optimistic that farmland values are going to continue to increase. And the way I like to look at that slide or that data over time is there's been an erosion of confidence in farmland values continuing to grow. I think that's exactly what you're picking up on the Indiana survey, Todd.
Yeah. And I think, you talked about sort of people being on the margin, right? So I think when you think about, farmers and how they think about land, there's sort of this group that's always optimistic. They think it's great. They want to own more of it. They love it. And then there's always this pessimistic group that like it's about to fall apart. And where the people on the margin are those that are switching from pessimistic to optimistic and back and forth being what's going on. And really, I think what's happening is that marginal group, the people on the margin, are now starting to be more negative.
Yeah, good point.
Yeah. Another thing, we can relate that back to the factors that Todd was talking about, because that's also my favorite chart. You go back in that 21, 22 period, all the factors are positive, like you're saying. Therefore, we had some pretty strong, a lot of people thought that land values were going to continue to increase, rightfully so, I would argue. And then we went into 23, where it was a little bit more mixed, still quite a few factors that were positive. And so we saw land values come, not quite as strong as they were in 21 and 22. And then we moved into 24, where more of the factors are negative, and we got less difference between those that thought land values were going to increase and decrease. And then, going on to 25, perhaps even more factors that are negative, and you're going to see it more. They're going to be more neutral overall. And so I think it all has to depend on these factors. How many factors are positive? How many are negative?
Well, and I think the ones that are positive, people feel less strongly that those are positive. And those things that are negative, they're feeling more strongly that those are negative, right? And so,
well, as economists, we always think the fundamentals are the returns and the interest rates. There is other things that impact land values, but those are the fundamentals. They're not positive.
Yeah.
So let's just kind of summarize here, Todd.
Yeah. So again, the kind of headline that I'm maybe getting tired of writing is that the Indiana prices are a new record high, right? Because that tends to be true more often than not as prices kind of generally increase. A lot like what we saw over the last year, sort of 4 to 5% increases year over year. We're kind of back to that kind of our expected change, right? We're cooled off a bit from those rapid appreciation we saw in 21, 20. A lot of that has to do with the interest rate pressure we've talked about, but also lower commodity prices, lower returns, putting downward pressure on land. Again, maybe the thing kind of keeping it up are things like development pressure or just fewer people wanting to sell land. But in aggregate, what we see sort of across the state is sort of modest growth from 24 over 23. The bulk of that took place at the end of 23. There's some signs that we're seeing declines through the first half of 24. People expect that to sort of continue going into 24. So it appears our respondents at least a little bit gloomier now than they were a year ago. And they don't seem to think that gloominess is going to go away magically. And so I don't think we're at a place where I say, prices are about to fall off a cliff. Things are down. There's still things keeping positive pressure, but maybe a little less optimistic about the remainder of 24 than we were, about the remainder of 23 a year ago.
So that wraps up our podcast for today. You can get full details on our website. And Todd, you've got a comprehensive report. You can also watch this again and download the slides that we were discussing as we recorded the podcast. So I want to thank my colleagues, Dr. Michael Langemeier and Dr. Todd Kuethe, for joining us today. And on behalf of the Center for Commercial Agriculture, I'm Jim Mintert. Thanks again for joining us.